Hello each and everyone, the one who is watching my video. This is Ankita, your commerce educator, welcoming you to Global Online, where we are taking classes for NET and SET exam preparation. In today's lecture, I am going to discuss 10 most important MCQ or a most accepted MCQ on the capital budgeting decision from the business finance unit. This is one of the most important topic from this unit because most of the time you will receive question from this. Okay. After watching this lecture, all your doubt will be the clear. Okay? और ये लेक्चर देखने के बाद आपको ये भी पता चल जाएगा कि किस तरह के क्वेश्चन एग्जाम में पूछे जाते हैं. ये लेक्चर देखने के बाद अगर आपके जो डाउट है वो क्लियर हुए या नहीं, ये देखने के लिए हम आपके लिए लेकर आए हैं फ्री इवैल्यूएशन टेस्ट. ये टेस्ट देने के लिए आपको हमारा जो ऐप है ग्लोबल ऑनलाइन वो अपने प्ले स्टोर से डाउनलोड करना पड़ेगा, जहां पर आपको ये लोगो दिखेगा. डाउनलोड करने के बाद आपको उसके स्टोर में जाना है और अपना जो पेपर है यूजीसी नेट कॉमर्स पेपर 2 वो सिलेक्ट करना है. सिलेक्ट करने के बाद उसके कंटेंट में जाना है और कंटेंट में जाने के बाद आपको जो टेस्ट है वो मिल जाएगा. ये जो टेस्ट है वो सभी स्टूडेंट के लिए फ्री है. ओके और एक इम्पोर्टेंट बात, ग्लोबल ऑनलाइन आपके लिए लेकर आया है कॉमर्स पेपर 2 कोर्स, जहां पर आपको मिलेंगे कंप्लीट वीडियो लेक्चर, मोर देन 100 वीडियो लेक्चर्स वी आर प्रोवाइडिंग यू, नोट्स वो भी डिटेल एक्सप्लेनेशन के साथ, टेस्ट सीरीज विद द डिटेल एक्सप्लेनेशन, प्रीवियस ईयर पीडीएफ विद द डिटेल एक्सप्लेनेशन. द ड्यूरेशन ऑफ द कोर्स इज 1 ईयर और इसकी जो फी है वो इंक्रीज हो गई है और वो अब है 7,000. अगर आप ये कोर्स लेते हैं तो पेपर 1 का जो कोर्स है वो आपको हम फ्री में प्रोवाइड कर रहे हैं. डोंट वेट फॉर द लास्ट मोमेंट, डू ज्वाइन अवर कोर्स एंड क्लियर योर अपकमिंग एग्जाम. Which of the following will not be counted as a part of incremental cash flow? Okay. So in this question they ask you, given which is not to be counted as a part of the incremental cash flow. For this the first option is opportunity cost. Now here the opportunity cost is the foregone benefit that will have been derived from an option not chosen. To properly evaluate the opportunity cost, the cost and the benefit of every option available must be considered and weighted against the other. Second one is sunk cost. Here the sunk cost in the economy and in the finance, the cost that has been already incurred and that cannot be recovered. In the economic decision making, sunk cost is treated as bygone and are not taken into the consideration when deciding whether to continue an investment project. Third one is external cost, such as a brand cannibalism. So here the brand cannibalism is an advanced science in the brand marketing battle. It is a process of creating different sub-brand of the present brand so that the present brand can grow its customer base by targeting a large number of the customer. And the last option is external benefits, such as the acquisition of a new technology which can be applied to the other project. Here the technology acquisition involves the assessing of a match between the technological capacity and the market opportunity, as well as the capability of the firm to observe and make a good use of the technologies that other firms are developing. For this question the correct answer is option number B. Sunk cost is a historical and will not change irrespective of whether a project go ahead or not. Therefore it shall not be counted as a part of project incremental cost. So the answer is option number B. Which of the following will be counted as part of an incremental cash flow? For this the first option is sunk cost. Second option is depreciation. Third option is an allocation towards the general company overhead cost. And the last option is change in the working capital. First of all we will see the each and every option. Okay, so what is a sunk cost? Sunk cost in a finance is the cost that has already been incurred and cannot be recovered. In economic decision making, sunk costs are treated as by-go and are not taken into the consideration when deciding whether to continue an investment project. Then is depreciation. The depreciation refers to an accounting method used to allocate the cost of tangible or a physical asset over its useful life. Depreciation represents how much an asset value has been used. It allows the company to earn the revenue from the asset they won by paying for them over a certain period of time. Then is allocation towards general company over cost. In business, overhead or overhead expenses refer to the ongoing expenses of operating a business. Overhead are the expenditure which cannot be conveniently traced to or identify with any particular revenue unit, unlike the operating expenses such as a raw material and a labor. And the last one is change in the working capital. Change in the working capital is the difference in the net working capital amount from one accounting period to the next. A management goal is to reduce any upward change in a working capital, thereby minimizing the needs to acquire the additional funding. Change in working capital will be counted as a part of incremental cash flow. So answer D is the correct for this question. Which of the following define the free cash flow? So here the free cash flow or a free cash flow to the firm is the amount by which the business operating cash flow exceeds its working capital need and the expenditure on the fixed asset. It is that portion of the cash flow that can be extracted from the company and distributed to the creditor and the security holder without causing the issue in its operation, such as it is an indicator of a company financial flexibility and is of the interest of the holder of a company equity, debt, preference stock and the convertible security as well as a potential lender and a investor. For this, the option given are: first is after tax operating income plus depreciation plus interest minus capital expenditure minus change in the net working capital. Second option is gross profit plus depreciation plus interest minus capital expenditure minus change in the net working capital. Third one is net profit plus depreciation plus interest minus capital expenditure minus change in the net working capital. And the last option is after tax operating income plus net shield plus depreciation plus interest minus capital expenditure minus change in the net working capital. Here the correct answer for this question is option number A, that is after tax operating income plus depreciation plus interest minus capital expenditure minus change in the net working capital. After tax operating income with the additional depreciation and the interest tell us how much actual cash is available for the owner of the firm capital. The project may also require the capital expenditure and may release or required more working capital. So option A will be the correct. Which of the following should be included as a start of the project? So from this, which should be included as a start of the project? For this, the first option is research cost. Research cost and historical cost will not be counted and the continuously value will become at the end. So here the research cost means the cost and the expenses that are actually incurred by or on behalf of the specifically identify or specifically allocated to the research activity counted under the research plan. Second option is historical cost. Historical cost is a measure of a value used in the accounting in which the value of the asset on the balance sheet is recorded at its original cost when acquired by the company. The historical cost method is used for the fixed asset in the United States under the generally accepted accounting principle, that is GAAP. Third option is investment in fixed and working capital. Fixed and working capital are both to a small business. Fixed capital include the asset or the investment needed to start and maintain the business, like a property or a equipment. Working capital is a cash or a other liquid asset that a business uses to cover a daily operation, like a meeting a payroll or a paying the bills. And the last option is continuation value. In a finance, the terminal value is also known as continuing value or a horizon value or a TV of the security is the present value at a future point in the time of that future cash flow when we accept a stable growth rate forever. So this is all about this option. Please understand the option. Please make this concept clear in your mind because you might receive any question on these options. Here the option C will be the correct answer for this question. Investment in the fixed and working capital. Which of the following will not be counted after the end of the project? For this, the first option is scrap value. Scrap value is a worth of physical asset, individual component when the asset itself is deemed no longer usable after a long-term asset such as a machinery, vehicle or a furniture. Second one is continuation value, which I explained you. Then is release of the working capital. Release working capital means freeing up the cash from the working capital to achieve an optimal cash operating cycle that lead to a higher business profitability. And the last one is change in the working capital. Here the scrap value, continuation value and the release of a working capital will all come after the end of the project. Change in the working capital are counted during the project. So the answer D will be the correct. How can we compare the project in case where they have a different lifespan? For this, the option 1 is use the annuity equivalent approach. Equivalent annuity approach is a one of two methods used in the capital budgeting to compare the manual exclusive project with the unequal life. Second option is use the perpetual equivalent approach. The perpetual calculation in a finance is a use in the valuation methodology to find out the present value of the company cash flow. The third option is use both perpetuity and the annuity equivalent approach, and the last option is select the project with the shorter payback period. Here the shorter payback period means the investment will be a rapid fairly shortly. In the other words, the cost of that investment will quickly recovered by a cash flow that invest will generate it. The correct answer here is option number A. Use the annuity equivalent approach is the correct answer. The next question here is what is a tax shield? For this the options given are the tax shield is the benefit which accrue to companies which are able to channel their fund through the tax haven. Second option is the tax shield is the benefit which accrue to a firm which are located in the special enterprise area. Third one is a tax shield is a phenomena whereby allowable expenses such as interest and depreciation reduce the taxable profit. And the last option is tax shield allow the initial capital expenditure to be offset against the tax when calculating the taxable profit. Here a tax shield is a reduction in the taxable income from an individual or a corporation achieved through a claiming allowable deduction such as a mortgage interest, medical expenses, charitable donation and the depreciation. So the option C will be the correct. What is a tax shield? So the tax shield is the phenomena whereby allowable expenses such as interest and depreciation reduce the taxable profit. When is the profitability index used? Here the profitability index is primarily used as a tool to rank the project. Higher the value of a profitability index, the more attractiveness of the proposed project is. For a single project, profitability index value of a 1 or a greater is acceptable. For this, the first option is when the capital is a ration. Capital rationalizing is an act of placing the restriction on the amount of a new investment or a project undertaken by the company. The second option is when the IRR cannot be used. Here the IRR means the internal rate of a return is the method of calculating the investment rate of a return. The term internal refers to the fact that a calculation excludes the external factor such as the risk-free rate, inflation, the cost of the capital, or a financial risk. Third option is when the IRR and the NPV conflict. Here the net present value or a net present worth apply to the series of a cash flow occurring at a different time. The present value of a cash flow depend on the interval of a time between now and the cash flow. It also depend upon the discount rate. NPV account for the time value of the money. And the last option is when the payback is a deemed to have a insufficient taken into the account at the time value of the money. The correct answer here is option number A. When the profitability index is used when the capital is ration. Which of the following is not a real option? For this, the first option is timing. Timing is all about the time. Okay. Here we are talking about the time. Second option is growth. Growth means how the company is getting growth or how the company is doing, how better is company is doing. Then is financial, and last one is exist. The correct answer here is option number C. A real option through based on the concept of a financial option is a concern with the real physical investment and not a financial investment. Okay. Financial means we are talking about the money of an investment. So answer will be option number C. Which type of real option will best describe a Killman example? For this, the first option is staking, second option is timing, third option is learning, and last option is all three. Timing, the option to delay until the business learn more about the strength of demand. Stagging, the project can brought on the steam in the stage as a business benefit to the project remain the uncertain. And learning, things are done on the smaller scale to learn more about the market. Okay. Option D is the correct, all three, that is stagging, timing and learning. So this question I asked you in my previous lecture. The question was the sum of a square deviation from a mean multiplied by the probability. Describe which of the following. For this, these options are given standard deviation, second is variance, third is correlation, and the last one is covariance. All these options I have explained you in my previous lecture. So for this question, option A is the correct, that is a standard deviation. This is the last question for today's lecture, and the question is in terms of relative risk, which of the following is the true? For this, the options given are debt is a risky for the investor while the equity is a risky for the firm. Second option is both are equally risky for the investor. Third option is both are equally risky for the firm, and the last option is debt is risky for the firm while the equity is a risky for the investor. Please answer this question. Write your answer in the comment box. I am waiting for your answer. Till then, keep watching, keep learning.